Okay, now we're going to have a good look at family trusts and just exactly how family trusts work. This is one of the biggest secrets of the rich, mind you, the family trusts, the ability of the trust to split income and protect wealth and things like that. And I'll be showing you some history about trusts and how they've been used over the centuries. Trusts are very, very ancient, and in fact, they've been around since the Middle Ages and the Crusades. The legend goes that originally back in the Crusades, when knights would go out to fight and to go out for the Holy Land and to basically win back Jerusalem from the infidels, as they saw it back then, but obviously their wealth and their family estates were concerned to make sure that they were looked after. So they would find a trusted friend and create a trust. And the trust meant the trusted friend held on to their wealth for them, took charge of their family's assets and held it for them until they came back. And that's basically the origin of trusts. And then from there, all various different categories and types of trusts have all been created over the last 600-700 years since the Middle Ages. So, very popular in the 1970s. That was when they really took off. Until then, family trusts are more just a family estate thing. They were never really a tax planning vehicle. They were more to preserve wealth, and they're about asset protection. So trusts were entirely about asset protection once upon a time. What happened in the 70s in the Whitlam era was that when tax rates went through the roof, when Malcolm Fraser decided that they were going to fund a massive welfare program, and income tax rates absolutely soared and hit like 66% at one stage on the top rate, that people started to work out that trusts had preferential tax treatment and started setting up discretionary trusts to basically do that. So that was where trusts really took off. And originally they were very popular to get income to kids at low tax. Government cracked down on that one. But still today, trusts are very effective to reduce tax. And the reason why is they tried to pass laws in 1999 to do something about that. Now, anyone want to guess why those laws didn't get passed? Who do you think have actually got trusts? Politicians? Farmers. So the laws never got passed. So what is a trust? A trust very simply is when one person takes responsibility or holds something on trust for another. A simple version of a trust is this, in a very simple form. Let's say that my son's a lot older and he comes to me and says, "Hey Dad, can I take the Porsche for a spin?" And I'm like, okay. And I give him the Porsche and give him the keys, he takes the Porsche for a spin. Now, assuming he does that, and assuming I'm not insane when allowing him to do that, he's holding it on trust for me. So let's just say that my son drives a Porsche off, he goes around, gets pulled over by the cops want to confiscate his vehicle. Ignoring like confiscation of assets and a few other things, I mean, what would he say to them? It's not my car. I'm holding this car belongs to my dad. Likewise, let's just say that you've got a valuable ring and you give it to your sister to hold for you, to give to somebody else. If someone comes up and wants to take the ring from your sister on the basis that they've got a lawsuit or against her assets, you'd say, well, hang on a sec, this ring is not mine. I'm holding it as a trustee for my brother, or my sister. So the trustee basically is basically what the trustee is somebody who's holding something on behalf of another. Although they have possession, so for example, even right now I've got a trust. By me holding onto this clicker, although I have possession of it, it looks like I own it. It's not mine. I'm actually using what belongs to the laptop up here. So I'm actually holding this on trust at the moment. All make sense to you? So a family trust or discretionary trust and a unit trust are probably the two main types of trust used in tax planning. There's actually 42 types of trusts. There's like blind trusts, they're bare trusts. Blind trusts are one of my favourite. They're used for doing purchases that you don't want people to know about. So let's just say, for example, you're a big company and you want to buy another company, but you don't want competitors to know because they'll block the sale, or you don't want the company to know that you're buying them. So let's just say that I want to buy my company next door, it belongs to somebody else, but I know that if they know I'm buying it, they won't sell it to me for market, because they'll be concerned about market saturation. I then get my friend Derek on a blind trust agreement, and Derek then goes and buys, and they think they're dealing with Derek, and then of course afterwards Derek transfers to me, no capital gains, no stamp duty, because it's on a blind trust. Who thinks that's sexy? Pretty cool, isn't it? Sort of stuff happens all the time. unit trust and discretionary trust, the main difference is unit trust, think of them like a company, okay? Think of unit trust a little bit like a company. A unit trust here let's say you got 4 unit holders. They all got fixed interest. Let's say you got a quarter each. Like a company, very much so, except rather than directors and shareholders, you've got unit holders and you've got trustee. Okay? Unit trusts in practice are often used to buy property together with other people, like a co-venture. They're used in certain business holding arrangements. Be aware that with unit trusts, banks, for buying property, banks these days just don't like lending them for some reason. They'll lend to a company, but they don't like unit trusts. It's very hard to find a bank that will lend to a unit trust. So that's what a unit trust is. Now let's look at discretionary trust. So unit trust, mind you, because there's a fixed interest, if somebody down here gets sued personally, then 1/4 of the trust assets are now going to be taken, okay? Let's say by contrast, you've got a family discretionary trust. So beneficiaries. So you've got the beneficiaries of the family trust. So you've got, the thing with the beneficiaries and family trust is no one actually owns the assets. So in simple terms, you've got mum and dad, trustee company. And let's say mum and dad, you've got mum and dad, you've got kids all down here. You've got companies that are owned, trusts, charities, pretty much beneficiaries, as long as they're family or charities or companies controlled or in some way owned or shared by family members, they can be beneficiaries. No one has any entitlement to that trust. So the beauty of it means is that the trustees are discretion. So the trustee is a bit like the girl, a bit like your sister having a ring. She's got the ring. And when someone wants to take the ring from her, she says, well, it's not my ring, I'm holding it on trust for my brother or for my brother's girlfriend or whatever else. Likewise, the trustee gets sued for the asset. Well, it's not mine. I'm holding this on trust for beneficiaries. Unless the trust is running a business through that trust, in which case then assets can be taken. If the trust is holding, say, property, and let's say you get sued over here, you're like, well, the trust has got nothing to do with me. I don't have any entitlement in the trust. I'm a contingent beneficiary. I may get money. It comes down to how nice the trustee is to me. So let's just say there's me, let's say there's mum and there's dad. Son gets sued. Son's like, well, it's dad's trust. I mean, dad can give it to whoever he wants to give it to. And even if dad gets sued, dad's like, well, hang on a sec, it's not mine either. I've got a legal requirement of trust law to give this money to whoever. In other words, I've got a legal requirement to distribute to anyone I want to, but I have to at least consider other beneficiaries. I can't just give it all to me. So a family trust is incredibly powerful for asset protection. Who sees that? Very, very powerful. It's also very useful to split income because let's just say that, father, mother, let's just say it works out that mum's got no income, then mum gets most of the trust income. So if you run share trading strategies through your trust and you've got a big day job income, you can put some money over to, say, your wife or your partner. You might put some to your kids, you might put some in a charity. And there's beautiful things of charity too, which I might add, which I'll be showing you shortly too. So yeah, unit trust I also should mention are partnerships. It's very common. Like, let's say that I'm just doing a small partnership where myself and my friend go into, say, selling internet goods online. We might choose to do a partnership just through a unit trust. One very big reason why unit trusts can be very useful rather than companies is you actually get an extra 50% capital gains tax discount off a unit trust when you actually sell assets in it, which you don't get in a company. So let's just say that unit trust sells off, let's say you're running a business through a unit trust, it sells off goodwill or company branding, it gets twice as much capital gains tax knocked off in the unit trust than will happen done in the company. So unit trusts are very useful. Discretionary trusts are different to companies. They're used for family or non-arm's length. That's why it's called a family trust. So make sure, people ask me, well, great, I can put my friends in there. No, there's very big tax complications and big problems the moment you start putting in non-family members into trust, apart from charities, okay? Who's in discretionary trust? Let's just quickly meet the people involved. So, because you should become very familiar with them, let's just identify each party. You got the settlor. Settlor basically is the one who gets the trust going. Okay? The settlor is the one who says, right, I'm creating the trust. In simple terms, I give my sister a ring and say, listen, hold my ring and give it to my girlfriend. I was a settlor. I created the trust. My sister is a trustee. She's the one who's holding it. And my girlfriend's my beneficiary. Not that I have one right now, but sister. So in simple terms, I give it to my sister. My sister's going to give it to my girlfriend. I'm settlor. Sister is, what do you call, trustee. Girlfriend is beneficiary. All make sense? So similarly here, settlor gives us a trust. Trustee manages. Beneficiaries are the people who benefit. Now let's just introduce you now to the appointor. Now, what's the best way to describe the appointor? An old boss I used to work for years and years ago said the appointor, really the best way to think of the appointor is God. The appointor is God to the trust. In other words, basically hire and fire, divine authority, everyone else is nugatory. The appointor can ultimately fire anyone it wants. So, a classic example, husband and wife, husband's a doctor, highly risky business, wife stays at home with the kids, or it can be reversed if we want to avoid gender stereotypes. But the one who's at home with the children should basically be the one who's the appointor, because they're not liable to be sued, while the father is more liable to be sued. So that's the appointor. The appointor, another way to think of it is the appointor is the puppet master. The trustee is like the puppet. So the trustee is the puppet. The appointor manipulates the puppet, can fire and hire them whenever they want to. All make sense? Again, I've just mentioned about here. The appointor can set the trustee at any time. So discretionary trusts ultimately reduce tax and they protect your assets. So you really want to make sure you use these things. If you're serious about building your wealth and serious about protecting it and keeping your tax down and going into business, doing shell, anything else, you want to use these things, seriously. They're rippers, they're great. They'll save you a lot of tax if you use them properly once you start building serious wealth. Let's just take a look at an example to help through this. So Dick and Dora have got 3 children, which is Jack, Jill, and Archibald. Now, Dick earns $100,000 per annum. Dora earns no income looking after kids. Jack earns $8,000 per annum working in a hospital helping victims of head injuries. And Jill and Archibald earn nothing. So Dick earns basically $100,000 per annum. So straight away, let's just say they make money from the trust, okay? So who's going to be the one straight away who's going to want to not receive any income from the trust? Well, obviously Dick, agree? Because Dick's got $100,000 per annum. Let's say Dick then does a share lot or E-minis trading or futures or something and makes 40 grand. So great. Now, let's just say Dick just did it in his own name. He didn't think about it. He just opened the trading account, through the broker, did it in his own name, traded away, and suddenly he goes, holy, cow. End of the year, $16,600 tax because he's traded in his own name. Dick would not be a happy boy. Now, let's just say that instead Dick was smart and he actually, before he started his share trading and before he started doing anything, he decided to set up a family discretionary trust. So assume Dick came to 21st century accounting, saw one of our guys, sets up his trust from day one, makes his 40 grand through his trading share lot. What's going to happen? Dick will basically distribute, say, I've got the figures here, like 20 grand to Dora, 11 grand to, say, Jack, 2.5 grand to Jill, 2.5 to Archibald, and $4,000 to a spiritual community. Now I'm going to show you why each of those. Dora, because she's got no income, she can earn up to $34,000 tax-free. Up to $34,000 and only pay 15% tax. Up to about $8,000 or something like that after the rebate, or $7,000, she pays no tax. 15% only up to that. Jack, same deal. Jack's over 18. Anything up to say $34,000, it's the same. So effectively, tax is being kept at 15%, and Dora even less because of the fact that she's going to have a tax-free threshold component. Jill and Archibald. Now, why is this important with them? 2.5 grand. We could have made it $2,600, mind you, but I chose 2.5. $2,600 is the minimum you can use for what's called Division 6AA, which means that children who are under 18, like Jill and Archibald, can only earn up to $2,600 from a trust. Otherwise, they pay 66% penalty tax. Okay? It's to stop people basically having lots of kids and giving them huge amounts of money and getting rid of their tax. But you still can give $2,600 from the trust to these children. So effectively, that's tax-free, that's tax-free. Now, here's another one. $4,000 to his church or his spiritual community. Now, is a church or spiritual community donations tax deductible normally, yes or no? The answer is actually no. Churches are not tax deductible, spiritual communities are not. There's nowhere in the legislation that does it. If you give your tithes or your gifts or your donations through your trust to your spiritual community or to your church, it's tax-free. It comes out of pre-tax income. Who thinks that's really, really fantastic? Often I say at seminars really sexy, but I'll leave that one out. But effectively, 4 grand tax-free, 2.5 grand tax-free, 2.5 grand tax-free, $20,000, $7,000 of that tax-free, $13,000 taxable, $11,000 taxable, 15% only. Difference? Profound. Dora pays tax of about $1,950, it works out. Jack pays tax of $1,595 about. Jill pays no tax. The spiritual community pays tax. It should be Jill and Archibald pay no tax, by the way. Total tax of $3,545. This gives a total tax saving of $13,055. Remembering Dick originally was going to pay $16,000, $600 on his trading profits, meaning he's only going to be left with $23,400 to keep building his trading account or live his dreams. Dick is now going to be left with something like $36,465 or something, or $455. So $36,500 effectively now Dick's going to have, rather than having $23,500. Is that a big difference? Especially if over 10 years he's compounding. We saw the power of compounding earlier on. We see why tax makes a massive difference to compounding. What if Jack earned 70 grand income? So in other words, the 18-year-old. Jack would have paid $29,050 tax if he traded in his own name. So if Jack did any trading, he would use his trust to split his income. Total tax of $5,485 is splits right. So that's if the income was different from the trading. So 70 grand was actually earned from it, then $23,000. So you can see a huge difference just by using family trust properly. Now, if Dick had a really large income which he couldn't distribute without a lot of tax, because let's just say Dick and Dora were both basically, let's just take an example. Let's just say that they're both on big incomes. Then what they might do is use a bucket company, which means that the company pays only 30% tax. So rather than paying 46.5%, they pay 30% tax. However, some things to note about bucket companies. Watch out for Division 7A penalties. And also the big thing is, under laws now from the ATO, you must basically pay out the bucket company. So let's just say that Dick had 40 grand from his trading and just paid all his bucket company. He must actually physically pay the money to his bucket company. He can't leave it in his trading account. The bucket company may then choose to lend it back. but you've got to actually pay the money over to get advantage of the lower tax rate. It's crazy. The laws just changed over the last 6 to 9 months or so. So third example is that Dora earns $100,000 per annum in income from a well-paid job. They have no children, let's say. The 40 grand goes straight in the bucket company. They pay 12 grand tax rather than $16,600. So still not as much as before, but you basically still save almost 5 grand, which is still a pretty good saving. Beware of bucket companies, just re-emphasising that point which I said before. The ATO have released these new strict rulings. Bucket companies can be used, but you must pay out the money to the bucket company. So if you're going to use a bucket company, get very careful tax advice before doing it. Now, if you're in business, also be aware of the capital gains tax exemptions. So you've got various exemptions: the discount, the active assets, the 15-year exemption, small business rollover, retirement, stamp duty. So what these are is, let's just say that you've got a business, and it's fantastic, by the way. It works out you can earn up to about $1 million profit and basically pay no tax in a business sale. So you can buy a business or build a business up, sell it off, and by using the active assets exemption, so 50% off, 50% off again, then the balance can be rolled over. So I'll give you a simple example of how powerful this is in your wealth building strategy. Let's say you build up a business in a trust, and it's worth $1 million, and there's let's assume that's a profit also. You want to sell it for $1 million. Normally you'd be up for tax of around about $400,000, $450,000. However, 50% gets taken off, and a further 50% gets taken off if you meet active asset requirements, which you normally will do in the business if it's done right. So suddenly your $450,000 only becomes $112,500 on $1 million. And it's possible, but if you roll over part of that gain to superannuation, or if you do what's called a small business rollover, which means you immediately buy into another business in a certain time period, they waive the capital gain or roll it over further, so you end up basically paying no tax at all. And if you held the business for 15 years, you're exempt completely. So for 15 years or more, you actually pay no capital gains tax on the sale at all. So I think that gives you some idea about the power of a business strategy to basically build up your retirement wealth. Buy a business or build a business, build it right up, build its value high, then sell it off, and you've got your retirement income. Put the money into super or whatever else, and effectively, after 6 years, I'll show you shortly, tax-free. So you can pretty much start to prepare yourself to live retirement tax-free and have a very good income. Let's take a quick look at some special tricks, just depending on different areas. Property investor secrets. Now, this is a very contentious little area, because one of the problems when you buy and hold a property in a trust is the negative gearing trap. So I'm just going to show you what I mean by this. Let's just say you buy a property in this trust. Okay? So you buy a property in a trust. Now, let's just say that the property, you earn a rent of, let's say, $30,000. But let's say your interest in your outgoings is, say, $46,000. That's $16,000. With me so far? Yep. Let's just say in your day job, you earn a $150,000 income. Clearly, you're going to want to offset the $16,000 against your day job income and effectively get back $7 grand tax, correct? Now, the problem is in a trust is that you can't move losses out of a trust into an individual name. So unless you've got either positively geared properties in that trust or in another trust, because you can transfer between trusts, or you've got shareholder income or business income in a trust, the losses stay in the trust until you've got enough money to cover it. How do people get around that? One way is a hybrid trust, which I'm not going to go too much into. It's a unit trust that gives certain schemes. The ATO have been onto them like anything and auditing them like no tomorrow. I just have never really got involved in them for that reason. The other way is to, as I mentioned, earn income or buy positively geared properties in the US or get other type of things like that, or do business or do share or do trading income and offset that against the loss. The third one that we did in the past, which was where the individual borrows the money direct from the bank in his own name rather than to the trust. The individual then lends the money back into the trust at a commercial loan rate, which means there's a markup profit. And it means because there's a profit on the loan between the individual and the trust, the individual can claim the negative gearing deductions in their own name. That's a simple term. So the individual now, because they're borrowing the money, they pay the $46,000. They get basically paid the interest plus repayments or whatever else coming through, or the rents or whatever else. So it basically works out that the individual is able to claim most of the losses in their own name, not quite all of the $16,000. As I said, the ATO in principle indicated it was okay. There's certainly case law that says you can do that. No two ways about that. The ATO have now gone ahead and said you can't. So we're in the middle of an objection right now. So that's just the state where things are at right now. We're buying and holding property in trust. Asset protection, great. Just have to make sure, again, you get proper professional advice to your situation to do this properly. The other one too, if you're a developer is considered to be carrying on a business of property. Okay, so developer is carrying on a business. That means that you do not want to hold your buy and hold properties in the same structure as your development. Why? Because do developers get sued regularly? Yes. So if you're owning all your buy and hold properties in the same structure as you got your development, what's going to happen if you get sued in development? You lose your properties. So you want to make absolutely certain, absolutely positively sure that you keep a separation between your development and buy and hold as much as possible. It's not always possible in practice because sometimes developers, develop and then decide to keep some properties in that particular structure to move forward. But as much as possible, you try and keep a separation between your private investing and your development investing. A brief, quick one I'll just touch on more than anything else. In WA only, if you actually purchase properties in multiple trusts, you actually get land tax savings. So that means that rather than in Victoria, Queensland, everywhere else, if you buy, let's say you get a land tax threshold of $400,000 or $500,000, whatever it is, but then every property after that, they aggregate them all up. And whether you do it through multiple trusts or individual makes no difference. In WA, if you had 8 trusts owning 8 properties, you get a tax-free threshold for each trust. Pretty cool. So it's a very good way to reduce your tax. I always get asked about renting the family home because people say, Warren, I've heard from my accountant that I should just buy the family home or transfer it into a trust or buy my next family home in a trust and rent it back. I mean, is that a good idea? I say, well, firstly, yes, in terms of tax deductions. And in saying that, I'm being a little bit coy here because the ATO don't really like it. They don't like it at all. Even though, as I'll show you, a massive negative is you lose your capital gains tax exemption the moment you do that. Because the way if you're renting your home off a trust, it's now an investment property for the trust. So you lose your capital gains exemption. It's a huge loss. So you wouldn't do it lightly. You do it because you weren't planning to sell it, and you do it because you're at huge risk of being sued. My home is owned in a family trust because of the reason that I'm fairly high risk of being sued. So I do it for that reason. Tax deductions, the ATO are really funny, and there's been court cases that pretty much said if there's a legitimate asset protection reason for doing it, you can claim the tax deductions. If it's purely to basically get tax deductions, you actually can't claim it. That's what the courts have concluded. So so in doing it, do you do it? One, you've got to make sure you're a big risk that's warranted. Secondly, you got to make sure you're not willing to sell it or willing to pay capital gains tax when you sell it, rather than basically in exchange for getting tax deductions now. Let's have a look at trading. Look, you can trade through a trust or self-managed super fund depending on the type of training. Again, I'm a huge believer in structuring yourself for trading. I've gone over and over that. Here's a big one: trader, not speculator. Very, very important that you get this one right. If you're not considered to be a trader, you cannot claim your expenses in carrying on your trading. You basically are treated under capital gains tax if you're a speculator. If you're trading, buying and selling options like willy-nilly, left, right and centre, and you do it regularly, you trade Forex regularly, you trade futures regularly, you do all that kind of stuff, well, different story. You can claim all your expenses against your trading income. So you want the ATO to consider you a trader, not a speculator. Tests, well, things like the ATO give a number of criteria that are probably worth writing down. One is the fact that repetition and regularity. There must be, the sign of a trader rather than a speculator is his repetition to their work. They're constantly making trades. A speculator will just do odd ones here and there. Secondly, system. A trader has a system to trade, but they don't just buy willy-nilly. A speculator just buys willy-nilly. A size of capital, although it's not a huge factor, it's still a factor. If you've got a lot of money, serious investment, yes. I'm also going to add, although the ATO don't mention this, I've found from experience a company trust structure helps too. It almost seems, remember, ATO people are just doing their job. It almost seems like that if it's in a company trust and with a trading plan, they just think, well, it's a business because it's in a trust. So perception is very powerful. So I very much say if you want to be absolutely sure, it's probably that's another very good reason why doing it at a trust could really help you. Claiming deductions, seminars and boot camps. I've gone through that already in some depth with Wealth Education. I just want to touch on it again. If you're a share trader, like you buy ShareLord and you already are trading the shares, or let's say you've already got shares and you're making income from the shares, for example. Well, your trading course of ShareLord is actually going to help you cover call writing and increase your income on your shares, therefore you can claim it. If you're already, say, in options or futures trading and you're doing ShareLord to increase your income as a trader from diversifying your business, of course you can claim it. By contrast, if you're just starting out, you never traded before, no, you can't claim it. Make sense? Okay. Internet tax secrets. Well, look, if you do internet masters or internet type of mastery or internet type of business, well, how do you structure? Interesting, because when you're just starting out and you're really, really basic and you're spending money, a lot of people are starting their own name, and I can understand it. If you're still feeling your way through feasibility-wise, you should be doing it. I might add, same with trading. If you're still feeling your way through your trading and you're not confident, you're not sure if you're going to commit yourself to a business of a trader, then to be frank, you're probably better off just do it in your own name in the beginning. If you let's say you're starting out with 5-10 grand, putting an e-minis account or ShareLord, just seeing how it goes, well, I would not be setting up a structure, to be frank with you. By contrast, let's say you got 20, 30, let's say you got 30, 40, 50 grand, you're serious about it, you've learned it, you're confident it can make income, well, you'd be silly not to set up a trust. That's probably the simplest answer I can give you on that one. If your internet, again, a bit of common sense, the biggest difference of internet compared to trading, you can be sued online, and ask Frank Kern and ask them, and Stephen Pierce, some of the big internet marketers, you can and you will be sued online if your products are defective or the American people, regulators, don't like your disclaimers or don't like you put in your site. They've shut down many businesses and they're ruthless. And the reality is most internet marketing will indirectly go into the US if you're selling products in the world market. So it's a very big risk to be aware about. Setting up a structure is extremely wise way to go. Internet marketing, you may even want to look at offshore structures, provided it's all declared and above board, more for asset protection reasons, and sometimes it can make a very big difference in terms of your credibility with PayPal, with clients having a US LLC or things like that. So internet marketing, again, if you just feasibility, not earning any income, just starting out, you may choose not to. But if you get serious or you're going to start a serious business from day one, well, please set up a structure. Do it. I mentioned about that already. Again, you want to make sure your internet site, you've got the right legal agreements in place as well. So if you're being sued or whatever else, then you're well protected, basically. So for example, you want to have templates like disclaimers, things like that. We do have available a template package that people in internet marketing can buy, which basically gives them all the disclaimers, all the things, templates that you need to put in your site to make sure you're legally covered. But that's really, really important. quite cheap to get to. Tax avoidance, I've touched on that a bit. I'm just going to touch on it again. I've gone through Part 4A in detail, so I won't really go through that again, and how now that's just applied to give insane amount of power to the taxation department. Operation Wickenby is something that it's probably been heard, but who's heard of it here? Yeah, I mean, we're basically, the ATO were given a massive amount of funding to target the rich and target people who were seen as diverting money offshore. And believe me, they have gone to town. Just about any accountant, lawyer I know who's ever set up offshore structures have either been interviewed by the ACCC and ATO, or else at least have had inquiries made about them. And that's just the reality. I mean, I've taught on offshore and that kind of stuff. I've kept pretty strict in terms of how I do and what I do it for within the law. I've certainly had some, I know I've had a few around me, every lawyer I know who's had anything to do with it. So believe me, right now the ATO are putting a lot of fear into people about offshore structuring. So I'm going to cover a bit more later on to say it's not illegal to do it. Again, however, a lot of what people promote it for is legal. It's only legal if you meet certain strict criteria and what you're doing it, and one of them is certainly not avoiding tax and living in Australia and trying to live a normal life and then have money hidden offshore earning your income. That's certainly not one of them. You need to have very careful planning. So make sure whatever you're doing in your structuring and in your stuff, be very clear to make sure that it's legal in what you're doing. Because now, if you do a tax-driven transaction, once upon a time, the old round robin, where in other words, you might have, I pay money to Derek pays money to Sid pays to Tom pays to somebody else, and then it ends up basically going around in a magic round robin circle and vanishing. Used to be some wonderful tricks that would happen and that would avoid tax, and now that would just be struck down immediately, the tax avoidance scheme. So the moment you start hearing things like that, like I've got to move money here and then move there and move there and move there, well, yeah, just be aware it probably will be. In practice, mind you, the ATO don't enforce Part 4A a lot. Just I will mention that on a practical note, because it's expensive to enforce and it's very legally costly because the amount of burden of proof that's on the ATO on certain things to do with the various factors. So in practice, unless it's a high amount of tax, from my observation, the ATO tend not to enforce Part 4A, but nevertheless it's looming as a sword, which you've always got to be aware of. So, okay, how to face the dreaded tax audit and come out alive. This is what it says, that the devil's talking. Said, I'm pleased to say, Mr. Mulrooney, but all your tax data, checks, vouchers, W-2s and 1099s from 1928 through 1984 have been forwarded to us. So, facing the dreaded audit. Just to explain how a tax system works, because I find there's a huge misunderstanding of people as to how it actually works. People think, okay, I've given it to my accountant, it's been assessed, great, it's done, I've given them my receipts. Giving your receipts to your accountant is not the same as giving your receipts to the tax office in an audit. I remember years ago, 21 years ago, when I worked for a tax office in audit, we did a desk audit on someone. We actually asked for all his receipts. We sent him a notice saying, we want all your receipts, we want you to come in. And I got called by him like next day. I got noticed. He said, is this Mr. Black? I said, yeah. And he goes, why are you sending me letters asking me for my receipts? I said, well, it's a standard audit. We just want to make sure you've kept all your receipts for your building business. And he goes to me, mate, I've given them to my accountant. Then used a few expletives. And he said, it's done and dusted. He said, the assessment's been issued, it's over. I said, no, self-assessment. I explained it to him how it works. He goes, no, don't spin me any about government, expletive again. This doesn't work. But he said, I'm not doing it. And I said, well, you're legally required to. We need the receipts. And he goes, mate, you keep asking me like this, I'll come and blow your brains out. Next he said that to me and hung up on the phone. So I went, okay. So I went straight to my boss at the time and I told him what he said. And he goes, gosh, he said, you've only been working here. It was in my first year. And he said, you've only been working in audit for 1 month. You had a death threat. He said, most of us have been here 10 years and never got one. That makes you famous. So we laughed about it. But I just laughed and said, I think the easiest thing to do is just issue him a notice and bring him in. But just make sure we've got couple of cops there, a couple of big thugs to sort of keep him in line. And I must admit, I actually was quite enjoying the experience. I felt quite a bit of a celebrity having a death threat. And anyway, We were actually very nervous about it. He turns up. We were waiting at 2 o'clock because what we did was serve him what's called a 264 notice. Now, 264 notice is a serious thing. If you get one of those saying you are required to attend the offices of the ATO at this time, if you don't, an immediate warrant gets issued for your arrest, and next minute you'll be in handcuffs being taken off. Okay, so if you ever get one of those, you do exactly as it says. And 2 o'clock came on the day. He never turned up. We go, oh well, looks like he's not coming, so we're going to have to issue a warrant for his arrest. So we walked out at 2:20 and we're about to start ordering it, and someone said, oh, there's a Mr. XYZ in the foyer to see you. We looked at each other. The two big burly policemen were standing there, and we're going, okay. And I must admit, I had a few heart flutters. And as I started to walk out, I saw him through the window, and I saw this massive guy with bright red hair, built big shoulders. And I was like, okay, my life flashes before my eyes. And and we walked out. He looked at me and just glared at me like this. And I said, hi, I'm Mr. Black. And he just glared at me and goes, he started crying like a baby and just bawled. He couldn't stop for about 2 minutes just crying. And we're like, he goes, why did you have to do that to me? You know, I was just scared. You know, now you scared me even more. I didn't know. I thought but my accountant got my receipts. I didn't realize it to give them to you. And we ended up calming him down, patting him on the back. It's okay, we'll sort it all out for you, and end up having a beautiful, amicable resolution. The point of our story was he got himself absolutely worked up because he could not disassociate the fact that his accountant had his receipt, so why did the tax office want it now? So self-assessment is very much like that. You do your tax and the ATO can audit you basically up for 4 years. Now, audit provisions. Section 26, just quickly, how do ATO choose audits? Well, this is just how the system works. Returns come in, but it goes through them. If you're over a certain claim threshold, whatever gets automatically referred straight over to, at least for look at. It's not random like people think. And then from there, case managers look at it and decide who they're going to audit. So that's why when you're claiming expenses and things like that, well, if you're going to claim an outrageous amount, I understand there's a good chance you'll either be audited or at least get what's called a preliminary audit, which means the ATO now, the last few years, have got this preliminary audit where they just ring you before issuing the assessment and ask you a few questions and ask for some proof. So it's a new system they've actually just brought in. So Section 264 and 264A, two very important provisions to understand of the tax law, which everyone should understand this. It's onshore and offshore. So you'll want to know these provisions. You want to remember them. And any Australian who values their rights and how tax law works and what they're allowed to do and what you're not should know these provisions at some level and what they're about. Now, 264 is basically the ATO's power to give you notice of an audit and demand information from you, or to basically just turn up one day and raid you. Okay? I worked at one stage in what I called raid audit. It wasn't the name, but the raiders. So what we would do is we'd descend upon poor unsuspecting businesses out of nowhere and ask for their records, so they wouldn't have time to do anything with them. And I can remember working for a few months in that section. And we would just get in our car, in our Commonwealth vehicle. I remember having this supervisor who was a very eccentric guy. He dressed in clothes that looked like he's from the 1950s. And we would drive out. We would walk into someone's house. We'd just walk into the business, like to a supermarket, and just say, hi, we're Peter and we're Warren from the taxation department. We've come to do one of our standard audits. Here's our Section 264 authorities. We show them our badges. And basically those badges are more power than the police, just so you know. When I had my own Section 264 badge authority, I had more authority than the cops. Cops are limited. They can't just walk on and raid you. They have to get search warrants. They have to go through procedures. For your interest, if you actually put a trespass notice against cops on your property and a cop walks onto your property without having a proper warrant, you can sue him for trespass at common law and you'll win. That's Plenty versus Dillon. Okay? So if you put a trespass notice saying that no one, including cops, actually you've got to mention cops, no government officer can come onto this property by order of Plenty versus Dillon, straight away cops know if they walk onto your property without going to get a warrant, they can be immediately sued by you and have substantial damages at common law. Who thinks that's cool? But 264 notices, different story. You can walk up onto the premises, out of your records, please, and we legally we have the right to complete cooperation now. Uncooperation, bang, we can take action against it. So we walked in, and I remember businesses would always treat you with respect and everything else. Some would be a bit more narky and a bit more nasty to you. But basically, huge powers. Pretty much the ATO can pretty much, without certain exceptions, do what they want. Go into your premises, ask for information, do that kind of stuff. Citibank case I mentioned, a very famous case where 1989, where they suspected that Citibank was being used for major money laundering internationally. So they got permission of their supervisor. At 7 a.m. in the morning, they wanted to get in before any lawyers got in or anyone else got in. That was the aim, to cause as much chaos they could. 72 ATO officers descended upon the Citibank officers and just basically broke in and demanded entry. And next minute, the few staff that were there see 72 guys walk straight in, flashing badges everywhere. Now you can imagine the absolute panic, of course. And of course, they just walked in, started to take documents, copy them, things like that. Lawyers were called, leaving their cups of tea behind, leaving their children still screaming with their nappy half changed, and racing down straight away to literally get down there immediately on the spot. I mean, it was that sort of serious. And then running around saying, no, you can't copy that. It's got legal professional privilege, which means if the communication was between a lawyer and between Citibank, the ATO cannot basically get access to that document. It's a very powerful exception to the ATO's powers. So I know in my lawyer capacity, if I want to make sure a document is never seen by the ATO or anyone else, I write it between myself and the client, and I actually make it subject to privilege. And that means that unless the client actually releases that document to the public or anything else, that document is sealed from an audit. So the Citibank case ended up where Citibank sued the ATO, went after them, basically claiming that they weren't allowed to do that. They were gross abuse of power, and they pretty much said no, well, what they did was okay. So I put in a bit of a colloquial terms, they have more power than the police and they can kick your ass. That's a very good summary of what onshore audits can do to you. So really a lot of it's about management, understanding that the ATO is actually, really most ATO officers just doing their job. They just got mortgages, they've got kids like everyone else. I will say this, when I worked for the ATO back in the 80s, in the very late 80s, there was a much more Gestapo culture of auditors. I personally think it has improved slightly. I've noticed that when I've represented clients dealing with auditors, I found auditors now being subject to what's called Taxpayers Charter, which has certain requirements of respect in the way they treat, are much better. I find they're more willing to talk things out and at least have a look at things properly, rather than just disallow something because they feel like it. I've actually found them to be fairly good. So in saying that, there's still certain things they can't do, and knowing your rights is always really a good thing to do. Offshore records audits. This is a big one. This is where the ATO has their power to get records offshore. So if they suspect you got records in an offshore jurisdiction, they can get them off you. This is what's called a toothless tiger, as Justice Hill described it in Falling. In other words, the ATO have got very limited power offshore. So they've got no power to demand records off you at all. They can only ask you very nicely. They can only basically ask you very nicely, please bring the records over. If you say no, they can't stop you. However, once you refuse an offshore information notice, the ATO can then ban you from actually getting those documents being allowed in court. So you can't then use those documents to defend yourself down the track any proceeding. So if you do refuse to do that, they can ban your production of those documents. But so, by and large, extremely, much more liberal, much more easy to deal with because of the limits offshore. I've helped clients with these 14-page notices where the ATO send notices, what's called an offshore information questionnaire, asking information. Again, really, I'd strongly advise you, if you ever get one of them, get legal advice, because how you answer them is critical. One thing I learned from ASIC investigators and from clients I've dealt with, 90 to 95% of clients who get prosecuted by ASIC and the ATO, they actually hang themselves on the gallows. Because to actually convict someone of these of prosecutable offences is not easy in our country on a lot of these. So ASIC know that if they sit there and put you in a room and they've got 3 officers glaring you down, you'll end up going, oh, and you'll just spill the beans. So ATO know the same thing. Most people, as soon as they walk in, they've got 2 ATO officers sitting there, they'll just collapse. Any facade which they've got will just collapse. And I found this when I used to audit people. We'd sit there, we would just sit there and we would just grill the person, and eventually clients would crack. So understand that. Yet someone who knew what they were doing, I remember one time a guy came to see me. The moment I started to talk to him, he was a lawyer in a big firm, and he was a very confident, quite steely looking man. And he said, well, you have no power to ask those questions, mate. He said, you better check your provisions. I was like, oh. I said, well, okay, well, I'll rephrase the question. He goes, okay, I'm happy to answer that. But it was much more like that. Before I knew, I felt like I had no command of the interview anymore. I would be asking questions. He'd be saying to me, well, he'd say, that's not what the position my client's taking. He denies what you're saying. What proof do you have? And before he knew it, I was actually feeling like I was the one trying to justify what I was doing. And in the end, we settled the matter, but the client ended up with an extremely good deal. Because I was only been doing it for a couple of years, and this guy was like a very experienced lawyer in a big law firm who clearly was used to dealing with people. So I found the more knowledgeable you are, the better. I found that when I've represented clients in ASIC investigations and things like that, without a doubt, I just tell the client exactly, I said, answer the questions honestly, but don't answer any more than what they tell you. So for example, if the ATO or ASIC asked you, did you have a bank account offshore? Well, the answer is yes. If you have one, is yes. It's not, yes, I had one over in the Bahamas and in the Falklands, and it was done this, and it was in a secret name, and it was all this. The answer is yes. Okay, what name was the account? Or if the account wasn't your account at all, and legitimately wasn't your account at all, and by the way, you don't do anything dodgy, but it's just an example of what I'm giving you. If the account wasn't yours, it was a company, well, no, it's not. No, I don't. Okay, well, did you have one through any company? Yes. Now you're being truthful. But if the ATO don't ask the question and say, did you have a bank account offshore? No, because you didn't. The company did. Did a company which you were involved in have one? Yes. Did it receive any money through it? To my knowledge, yes. And in other words, you're just answering the question as given. The transaction here that we see, that the $85,000 that left your Australian bank account and went over to Vanuatu, what was that for? It was to buy goods and services from Vanuatu. What types of goods and services was it to buy? And then you go from there. Do you understand what I'm saying? So it's really very much about how you answer them. So you're always truthful, you don't lie. But handing an order is about, being completely cooperative, being completely truthful, but only answering exactly what you're asked. Okay? So you have a lot more power with offshore as well as onshore. I might add, one of the problems is psychologically for audits or ASIC investigations, and they know this. The ATO and ASIC know this very, very well. The psychological factors involved is that a lot of people feel really like almost guilty. And so when ASIC start to ask questions to ATO, they almost feel like I've done something wrong. Half the time you actually haven't. If you have, and they ask the question and needs to come out, yes. If you've really done something wrong, like you're being audited and you knew you took cash money, then I've actually often just said to clients, you're actually better off to voluntarily disclose before anything happens. You just come straight up front and say, look, I took cash money. At the time I was doing this kind of stuff. How do you want me to deal with it? And ATO are actually very good when people do that. When people just come straight out and say, look, I took cash money on the side. I laundered $100,000 through this way. I'm sorry. I was under business pressure at the time. What do you want to do about it? The ATO generally, I've never seen them say, right, we're prosecuting you. They'll say, okay, well, do you know how much it was? No, I don't. Maybe 80,000 and maybe 100. Okay, well, let's just work out whatever and work it out from there. So, not random. Project orders, they audit teachers and contractors a lot, mind you, but, different people. ATO internal policies, also audit criteria. I've mentioned there are certain expense claims that I've already gone through. Fishing expedition. Just be aware that one thing they have said, the ATO can't go on a complete random fishing expedition. They've got to have a little bit of purpose to why they're asking you questions. And there have been cases where the ATO have just gone virtually bananas, and the courts have said, well, hang on a sec, you've got to have some kind of purpose. You just can't go on a random fishing expedition to find information. Engaging competent counsel. If you're going to be audited and if you're unsure, and I would say anyway, if it's going to be on your business and it's a reasonable amount, you should definitely get your accountant or lawyer or someone to help you in that situation. And very importantly, as I mentioned, respect the ATO. They are people just doing their job.